Hi everyone, it's Mike from Order Flows and welcome to the Order Flow Dynamics course module number 12 on putting it all together. Now this is the last module in the course and hopefully by now you've learned quite a bit about order flow. Now the purpose of this course is not to convince you that you must add order flow to your trading. You should already know and understand the benefits of it. What I'm trying to do is expand your mind into new ways to analyze and trade your existing markets. The goal is that you will hopefully find a way to implement the parts of order flow analysis that fits with your trading method in order to maximize and improve your trading results. Now, in a trading day, it is impossible to predict which trades will be winners and which trades will be losers. Another thing impossible to predict is the amount of profit a winning trade will produce. The one thing that can be predicted is the exact amount a trader is willing to lose on a trade in the trading day. Now, what I mean by that is, you can say, well, I'm going to only risk $200 on this trade. You can't say, I'm going to risk $200 on this trade, but I'm going to make $1,000 on this trade. The market may not give you the $1,000. It may only give you $100. It may only offer you $300. So while you can define the amount of risk you're willing to take on a trade, you can't define the amount of profit on a trade. The market decides that for you. Just as you can't say, well, I'm going to make $2,000 today. Okay, you could say I'm going to risk $500 for the day, and if I hit that, I can stop. But you can't say I'm going to keep trading until I make $2,000 today, because you might run into your minus $500 risk level. And the important thing I want to impress upon you is you have to take the trades when they come. Okay, if you don't take the trades when they come, you're going to put yourself at a disadvantage, because you've developed your own edge. But if you're not taking the trades as they present themselves, what good is your edge? For example, if you're just trading prominent points of control, okay, there's a buy right here, just pure prominent points of control, nothing else. You got a buy, okay, it failed, you got stopped out. Another buy, yeah, you made something on it, then you got a bearish prominent point of control, it gives you a small loss, then you got another bearish prominent point of control. If you just look at this and say, oh my gosh, I had 1, 2, 3 trades, only one winner, I'm not going to take this next one. Oftentimes, it's that one that you sit out that gives you the profit to recover from your previous losses. So you take the trades when they come. There's another example. My bread and butter trade, the trade that I'm always ready to take as soon as I see it, is a ratio and divergence, right? You got your blue number, you got your divergence up there. I always take these, right? Sometimes I get stopped out, okay? Sometimes I notice the order flow is changing and I cut my loss. But then if I sit out the next one because, I had a small loss, I got to wait for it to start working. By the time it starts working, I've already missed that trade, right? If I don't take this other trade here, which, recoups the small loss that I had earlier, that affects your bottom line by not taking the trades when they appear. So for a trader to make money, you have to take the trades when the edge is present. That means each and every time, not, I had 3 losers in a row, so I'm going to sit the next trade out and get my bearings back. You might think your edge is gone, but is it? Losses do come in groups. Trading is a process, and part of the process is having losing trades. Once a trader embraces that, then they understand that despite facing a losing streak, they can still come out ahead, right? Just like in baseball, right? You hear this example so many times. A person is a 300 hitter. They're not going to hit the ball every single time. They're going to hit it, 30% of the time because they're only a 300% hitter, right? Just as in basketball, right? A free throw shooter. He could be a 80% free throw shooter. Doesn't mean he's going to hit all the free throws when he comes up to the line, okay? And there's going to be streaks involved, right? Like, Shaquille O'Neal, terrible free throw shooter, but there's times where, he goes 7 out of 8, when his overall free throw percentage is 50%. So, bear that in mind when you're trading. Now, what distinguishes a good trading opportunity from a bad trading opportunity is often found in the surrounding order flow. The context of the pattern in relation to the developing surrounding order flow impacts the success or failure of the trade. You got to recognize the good from the bad. Okay, this is good, right? You got your selling coming into the market, right? You're seeing the negative deltas, you're seeing lower points of controls. You're seeing the red bars with higher points of control relative to the previous one. This is what you like to see. Okay, that's good order flow. Okay, bad order flow in here, right? You see the market jumping around, right? You got the stack selling imbalance, but then you see positive delta, then negative delta, then positive delta, negative, 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 then positive. Okay, this is bad if you're getting short, right? It's getting ready to turn around and come back up, right? It's not smooth move down the way the previous chart was. You know, and when I'm talking about bad, I'm talking about not Michael Jackson bad. You know, I mean bad mean, you know, not bad meaning good. Bad meaning the surrounding order flow is choppy or not consistent or not in a direction, basically, right? You know, if you're looking for a market to move up, you want to see, you know, positive deltas, you want to see higher points of controls, you want to see buying imbalances. On a market moving down, you know, you want to see negative delta, you want to see lower points of controls, you want to see selling imbalances. More importantly, look at the internals. Look at max delta. Look at min delta. Look at cumulative delta. Where are we in cumulative delta? Are we moving or are we still the same? Look at the max delta. Look at the min delta. You know, even though bars have a positive or negative delta, sometimes when you look deeper inside of the max and min delta, it can clear it up for you a bit. Like, you know, are we slanted more on the max delta or on the min delta, right? And if it's not giving you any clear clues, then you just stay out. Wait for the times where it's really dominant. Like this whole area that you're going sideways in, right? It's choppy. Things don't clear up until you start breaking out right here, right? You see the multiple selling imbalances. You see the negative deltas. Look at the min deltas. It's all min deltas. Very small max deltas. 0, 75, 2, 4, right? Multiple selling imbalances, lower points of controls. Obviously, you got negative delta as well. Cumulative delta is weaker than where we were, you know, say 10 bars ago. So, you know, it's all showing up here as positive. I mean, I'll say positive, the market's going down, but what I mean is good order flow in a direction, whereas here is bad order flow. The market is going sideways. Now, there are differences in order flow between markets because of the participants, okay? Major markets such as E-minis and QCL have a good mix of participants between prop, retail, institutional, and commercial traders. Specialized markets that don't see as much retail or prop activity, such as deliverable commodities such as wheat, corn, bean oil, bean meal, you know, are driven predominantly by supply and demand, and as such are just about completely dominated by commercial and institutional traders who leave clear footprints in the market. You know, there are prop traders in corn, in wheat, in soybeans, bean oil, to a lesser extent meal. But, you know, these markets, you know, take a look at commodity markets as opposed to the financial markets, and you can see the differences. You know, personally, I believe that order flow follows some of these commodity markets really well, even better sometimes than the financial markets, because they're real. There's so the percentage of retail participation is quite small. Okay, so really what you have is big players dominating it, right? And that's why you read the order flow, because you want to follow the big players. So if you're looking at a market that's dominated by big players, now that's not to say there's no big players dominating the E-minis, but you also have a lot of other smaller participants there. So imagine trading the E-minis and you remove all the smaller participants, right? And all you're left with are the big guys leaving these big footprints in the market, right? That would make trading much easier for you, wouldn't it? So take a look sometimes at the other markets and compare, and you can start seeing the differences, what I'm talking about. You know, wheat, boom, right on the high of the day, you can see the big sellers right up there at the high. Okay, versus E-minis, yeah, you know, it's kind of, you do get prominent points of controls, but oftentimes, you know, the volumes tend to be distributed a bit more evenly than in markets that are dominated by big players, right? By big buyers, by big sellers. Now, what makes commodities more interesting to trade is the fact that they're generally renewable resources and are often subject to cyclical forces that stock indices are not. Okay, they are deliverable as opposed to cash settled, right? Stocks are cash settled. Things like corn, wheat, you know, those markets are deliverable contracts. But what really has strong force in commodity markets are supply and demand, because commodities can experience disruption in production, delivery, supply, and cyclical demand, right? You don't have generally disruption in the S&Ps, right? You don't have delivery problems in the S&Ps. It's a cash settled contract. Whereas corn, or these commodities, if there's a flood, on the Mississippi, that's going to affect the market, right? If there's too much rain, farmers can't get out and harvest the crops. Those are things that affect supply and affect demand, right? That just don't exist in, these other contracts such as E-minis or NASDAQ. Now, observe what markets do at overnight highs and lows, okay? And if the market can't get into the overnight high or low, why? What's stopping it? Because if it can't get beyond the high or the low, if it's going to stay in there, there's probably something bigger afoot. Okay, so just understand that, if you can't reach those highs or lows, and whenever you get to a high or low, an overnight high or low, watch it. Does it trade through it? Theoretically, you should, during the day, if you come into the high or the low, you should at least breach it. But if it can't, pay attention to it. Pay attention to the order flow, what's going on, right? This is an example of the E-minis, right? We're coming down into the overnight low down here, 31.25.5. Then strong buying came in. You could see, at one point, the delta was minus 956 and settled up 1767. Okay, have these references in your mind. Know where the overnight high and low is. Okay, so if you get outside of the overnight range now this time we're starting to trend, right? Because we're taking out the overnight high. If you get outside of the overnight range and you struggle to get back into it, watch the order flow, because the market could begin to be trending. Okay, so here's an example, right? This blue line is the overnight high, and we came up to the high, we took it out, came back inside, took it out again, came back inside, we retraced, right? So up, this is the next part here. This one stops at 11:30, this one picks up at 11:30. Then we start coming back in, taking out that overnight high again. Okay, so what happened is we took out the high, came back in, right? You got some selling, came in, we took out the overnight high, let's sell it, come back in, took out the overnight high again, some more selling came in, took it out again. And then you start trading up. Now we're not even retracing. We hit a new high, we're not even pulling back anywhere near that overnight high, and the market is trending, right? It's starting to form a new structure. You're going into a vertical move, right? And it moves from, the 64 area all the way up to the 74 area. So, watch those overnight ranges. Those are important. Watch the order flow around them. So we've covered a lot of topics in the order flow dynamics course, and the goal is to get you thinking outside the normal trading methods of just looking at price, and consider the aggressiveness of volume traded and market context, right? And more importantly, understanding the surrounding order flow when you're coming into a level, right? Is it bullish? Is it bearish? These are questions you should always be asking yourself when you come into a level. So thank you for completing the order flow dynamics course. Take what you have learned and apply it to the market and improve your trading. So happy trading. Thanks everyone. Bye-bye.